Hi, I'm John Huang and you're watching the Junior Investors Club. For today, we'll talk about buying puts. But before we begin, quick disclaimer, I'm not a licensed professional, so I'm teaching theory in all my lessons. Therefore, any stock references will be only for educational or teaching purposes only. Most importantly, please portfolio size and do your own due diligence. Thank you. So in the previous class, we talked about calls, how to buy and how to sell. And today we'll cover about puts, right? And how to buy them. So whenever you buy a put, you actually own the right to sell, right? That means that if you already own shares, like 100 shares, and you buy a put, right? You choose a strike price at whichever one you like. And when the share price falls, you actually can sell your shares at the pre-selected price rather than the market. So it's in a sense a way to hedge your positions or to protect yourself from downside, or maybe even to profit from downside, right? So the idea is quite straightforward. It's just like buying calls, you own the right to buy the shares. For buying puts, you own the right to sell the shares at the pre-chosen strike price, right? So by now you should get the hang of it, right? So let's simply go to the demo and see how it works. So here I am back at the demo on my demo platform, and you can see that these are the shares that we bought prior, right? We bought them at 408. Currently now it's 457, and we want to protect our position, right? We want to protect our position from further downside, right? So this is what we do, right? So simple, we take a look at the charts, right? Just to make sure that it's, we see that it's starting to go on a downtrend a little bit. So we want to protect our position, right? So what we do is, let's just say we want to sell our shares at this price, 457, right? We'll simply go to pick a time frame first, same like the buy call. Let's pick February, right? It's about 3 months out, so that should be all right. And we simply choose our strike, 458. All right, I think this is all right, right? And here's the difference. Instead of choosing things on the left-hand side, now we're going on the right-hand side, right? We're looking at puts. Right? Remember, this is the call side, this is the put side. So we are looking at the put side, right? So I will simply just buy a put, right? So it's going to cost me about $18.13 to buy a put for 3 months out, which allows me to sell my shares at 458. So in the event that the shares drop further, let's just say they drop to 400 or something, I can exercise my right to sell it at 458 when the market price is 400, you see? So here's the thing you need to confirm, right? Just to double check, right? The maximum profit that we can get is $43,000, right? And the maximum loss is 1,812, right? And that is just the price that we are paying for, like 18 times 100, right? So whenever you buy a call or you buy a put, the maximum loss is always the price you paid. And the maximum profit is always, a very high amount, and infinite in terms of call, because stocks can go as high as they want. But in the terms of a put, right, the stocks can go down to zero. So if the stock ever reaches zero, this is the maximum amount that you'll get, right? So we'll press send and it goes through, right? So the thing about puts is that the thing about buying a put or buying a call, right, is that you own the right to this position, right? So whether you exercise or not is entirely up to you. So you do not necessarily need to have 100 shares when you do a buy put. Same like for a buy call, you do not need the money if you do not intend to exercise, right? So the 100 shares in a buy put is optional, okay? But it allows you, it's a good way to hedge your position, right? So it's all right to have as well, okay? So let's go to the future and see what happens. So I fast forwarded to the future, right now, January 31st. And we can see that our share price has actually fallen, right, from about 470 right down to 441, right? So let's take a look at what our position has become because of the drop in share price, right? So we can see that we got our strike at 458, and as the share price drops 442, it's about a $20 drop, right, thereabouts, right? We've earned about a 54% increase on our premium, right? So remember, we paid about 18 or 17ish, almost 18 when we did it, right? And currently now it's about worth $27, right? So we've earned about $10 or about $1,000, 966 thereabouts, right? So just by that, we are able to earn a profit when the share price falls, right? And we don't necessarily need to own the shares either, right? Because it's up to us as the buyer of the contract to choose whether we exercise or we close the contract, right? So we can either just close it to collect the 996, or we can just sell our shares at $458. Either way, it's up to you, right? So that's the end of how to do a buy put. It's very simple, right? You simply pay a premium, and if the share price drops, you can either take profit or exercise. But in the event that the share price increases, then you will see that your 1784 actually starts to decrease in value, right? So that's when you start to incur losses, okay? So when you do buy a put, you need to make sure that the share price is dropping, right? Then you earn a profit. But if it increases, then you start to see losses, okay? So that's it for buy puts. It's really simple, right? So if you found this informative and you really like this sort of content, right, please feel free to like and share this video. And if you want to watch more, please remember to subscribe and turn on that notification button. And yeah, I'll see you guys in the next video. Bye.